What if I told you that while most investors were panicking over a Friday sell-off, the smartest money on Wall Street was quietly loading up on one of the most misunderstood electric vehicle stocks on the market? And what if the very event that triggered that panic was actually the single best gift the market could have handed long-term investors? Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the trades that actually matter. And today, we are diving deep into Nio, because after what just happened last week, the question everyone needs answered is whether this stock is coiling up for a massive rebound driven by real insider conviction, or whether dilution fears are about to slam the brakes on this entire setup. The short answer? The data is telling a very specific story, and by the end of this video, you are going to know exactly how to read it. We are talking profitability ignitions, algorithmic support floors, institutional fingerprints, a short squeeze sitting on a hair trigger, and a product launch on the horizon that could rewrite the entire narrative. Buckle up, because this is the full breakdown. Let me start by painting the picture of what actually happened last week, because there were genuinely two completely different Nios trading in the same week. On one side, we had the fundamentals, and they were stunning. Nio posted a non-GAAP profit of $178.9 million for the fourth quarter of 2025. Now, Wall Street analysts, the professionals with the Bloomberg terminals and the research teams, were projecting somewhere between $102 million and $175 million. Nio didn't just beat estimates, they blew straight through the ceiling of the most optimistic projection. That is not a beat, that is a structural shift in how this company should be priced. On the other side, the stock hit my publicly predicted $6 breakout target, reached an intraday high of $6.21, and then pulled back hard on Friday to close at $5.43. For the casual observer scrolling their portfolio app, that Friday drop looks like a red flag. For the disciplined trader who understands market mechanics, that pullback just created a textbook entry zone sitting on top of multiple major technical support floors. And buried inside these earnings, there is one specific hidden metric I will get to shortly that completely changes the long-term margin story for this company. So let me give you the profitability picture in full. For years, literally years, Nio has carried the label of a cash-burning startup, a company chasing a dream on borrowed money and borrowed time. That narrative officially died last week, when a company posts $178.9 million in non-GAAP operating profit and simultaneously guides for 90% to 97% year-over-year delivery growth in the very next quarter, targeting as many as 83,000 vehicles in a single quarter. You are not talking about a startup anymore. You are talking about a scaling profit machine. This is what I call the ignition switch moment. It is the precise inflection point where a company stops relying on capital markets to survive and starts generating the fuel to grow itself. If Nio hits those delivery targets in the first quarter of 2026, the startup label is gone permanently, and every analyst who has been applying a discount to this stock for being pre-profitability will have to reprice it. Could they miss those targets? Sure. But would it really shock you if a company that just smashed every estimate on the board showed up and delivered? I didn't think so. Now let's talk about the price action, because the chart told a very precise story last week. On March 14th, I laid out the $6 level as the critical short squeeze trigger zone. On Monday, the stock did not gradually drift up. It exploded. Intraday high of $6.21. That is an exact test of the resistance level we mapped out in advance, down to the cent. For those who caught that initial breakout, the setup was clean. But then the week turned, and three specific factors drove the Friday correction. First came dilution fears. On March 19th, Nio filed a large shelf registration signaling the potential issuance of additional equity. The market despises dilution in the short term. It sees more shares as immediate value erosion, and profit-taking was instant. Second, the technicals were simply overheated. The relative strength index reached 68.89 by midweek, sitting just a razor's edge under the overbought threshold of 70. A mechanical pullback at that level is not a surprise, it is almost mandatory. Third, the broader consumer discretionary sector hit turbulence, dragging Tesla, XPeng, and the entire peer group down with it. None of these factors represent a change in the fundamental story. They represent a normal market exhale after a sharp run. Here is where it gets really interesting. While retail traders were interpreting Friday as a disaster signal, the sequence of events throughout the week was telling a completely different story about where the sophisticated money actually stands. Monday and Tuesday were pure accumulation, heavy volume, an HSBC upgrade, sustained trading above $6. Wednesday brought something even more telling, SEC Form 3 filings revealing that top Nio executives, including the United States CEO and the Chief Financial Officer, are sitting on heavy vested internal holdings. These are not people who filed the shelf registration because they are worried about the company. Wednesday's institutional data confirmed conviction at the highest level of the organization. Thursday brought the shelf registration pivot that spooked the market. Friday delivered the correction that reset the technical entry point to $5.43. And here is the critical question you have to ask yourself. If insiders with access to every internal metric, every delivery number, every chip development milestone, every partnership negotiation are holding their shares through a dilution filing, what does that tell you about what they expect to happen next? The institutional footprint answers that question even more directly. While retail was panic selling on Friday, the big money was doing something entirely different. UBS increased its Nio position by 4,000%. 4,000. HSBC boosted its position by 49% in a single month. We are now looking at 472 total institutional owners holding over 321 million shares. When firms of that caliber move with that kind of aggression into a position, they are not positioning for a trade next Tuesday. They are positioning for the next 3 to 5 years, and the analyst community is backing them up. Nomura just upgraded to a buy with a target of $6.60. HSBC is at $6.80. Goldman Sachs has pushed their target all the way to $7 even. That is a consensus of conviction from 3 of the most influential institutions in global finance, all pointing at the same upside destination. But here is what most Nio watchers are still completely missing, and this is the part of the story that genuinely changes the long-term margin calculation. Nio is not just a car company anymore. On March 17th, they signed a strategic partnership with Tuhu Car to expand user operations and ecosystem revenue. But the partnership that should have every EV investor paying attention is the one with McLaren. Nio is now supplying battery packs to McLaren. Yes, the McLaren, for high-performance applications. When a hypercar manufacturer chooses your battery technology over every other option on the planet, you have crossed a threshold that no marketing campaign can replicate. That is third-party validation of world-class engineering. And then there is the hidden metric I promised you, the one that quietly transforms Nio's margin story. Most electric vehicle manufacturers are dependent on expensive third-party chip systems, often from NVIDIA, which carry significant per-vehicle costs. Nio developed its own proprietary Shenji chips. The direct cost impact? A 10,000 yuan reduction per vehicle built. That is pure operating margin flowing straight back to the bottom line at scale, and Nio is now in active discussions to supply those chips to Leapmotor and Geely. They are not just an EV company, they are becoming the semiconductor backbone of the autonomous driving ecosystem. Think about what that means for valuation multiples if that revenue stream matures. So, where does the stock find its floor? We have identified what I am calling the algorithmic support zone. Friday's close at $5.43 brought the stock right to the edge of a dual technical support structure. The 200-day moving average sits at $5.35. The middle Bollinger Band sits at $5.28. These are not arbitrary lines on a chart. They are levels where institutional algorithms are systematically programmed to initiate buying activity. If the $5.35 level holds, the path of least resistance points back upward. And the fuel for that upward move is already preloaded. There are currently 147.19 million shares sold short, with 3.99 days to cover. Those short sellers are sitting on a powder keg. The moment this stock pushes back above the $6 psychological barrier, every one of those short positions becomes a liability, and those traders will be forced to buy back shares at any price available to close out. That forced buying becomes rocket fuel, potentially catapulting the stock directly toward that Goldman Sachs $7 target. Could the stock stay pinned below $6 and let the shorts win this round? Is there any real chance of that happening when you have 472 institutions loaded in, insiders holding firm, and the options market screaming bullish? The options data confirms the direction. Flow is 82.82% bullish. The March 27th $5.50 calls are seeing massive liquidity, and they carry a gamma of 0.7991. As the stock moves toward 550, market makers are forced to purchase millions of underlying shares to hedge, a gamma squeeze effect that can turn even a modest rebound into a significant rally. Here is the trade setup for the week of March 23rd. The entry zone is $5.40 to $5.50, buying the bounce off that 200-day moving average. The support limits are $5.31 at the Ichimoku Kijun and $5.28 at the SMA 20. The conservative target is $6.25, but watch the $5.86 recent pivot as the first confirmation of strength. Clear $6 and the short squeeze ignition sequence begins. And beyond next week, the April 9th horizon is what makes this more than just a short-term trade. On April 9th, Nio launches the ES9, a vehicle integrating their 5-nanometer proprietary chips alongside state-of-the-art steer-by-wire technology. This is the catalyst for the next wave of pre-order momentum, media coverage, and analyst upgrades. Every delivery beat between now and that date adds compounding credibility to the bull case. Before I wrap up, I need to give you the disclaimer that responsible investing always requires. Nothing in this video constitutes financial advice. I am not a licensed financial advisor, and everything discussed here is for educational and informational purposes only. All investing involves risk, including the potential loss of principal. Always do your own due diligence. Consult a qualified financial professional before making any investment decisions, and never invest capital you cannot afford to lose. Past performance of any stock or setup discussed here does not guarantee future results. Nio carries specific risks, including continued dilution, execution risk on delivery targets, geopolitical exposure, and broader market volatility. Please invest responsibly. Now here is my final take. A company that just posted a historic profitability milestone, guided for nearly 100% delivery growth, secured a McLaren battery supply deal, built proprietary chips that saved 10,000 yuan per vehicle, attracted 4,000% institutional buying from UBS, and holds executive insiders who refuse to sell. That company is not in trouble because of a Friday pullback. That company is in a buyable dip sitting on algorithmic support with a short squeeze locked and loaded and a major product launch weeks away. The strong buy narrative has never been more alive than it is right now. So here is the question I want you to answer in the comments below. Given everything we just covered, the profitability ignition, the McLaren deal, the Shenji chip margin story, the institutional accumulation, what is the single factor you think will have the biggest impact on NIOs stock price before the ES9 launch on April 9th? Drop your answer below, because the most insightful comment always sparks the best conversation on this channel. If this breakdown gave you a new angle on the setup, hit that like button. It takes 2 seconds, and it genuinely helps this video reach more investors who need to see this analysis. Subscribe to Smart Stock Sam so you never miss a breakdown like this one. And if you want to help this video climb the YouTube hype leaderboard, share it with one person in your circle who follows electric vehicle stocks. You might just be the reason they catch this trade. See you in the next one.